Hi guys, Chris Jansen, Harcourts. Hope you're all well as always. I've got a spare 5 or 10 minutes here. I'm at a property locally in Burton, just about to show a prospective buyer through. But before I did, I just wanted to take this opportunity in my day to reach out. I've had a few people contact me in the last day or two to discuss a particular item which aired on 60 Minutes on Sunday night, talking about the Australian housing market, current mortgage and debt rates and serviceability attributed to that, and the old talk of the Australian property bubble. So I just wanted to delve into that, I guess, and provide a little bit of reassurance, but more so clarity on the facts and relate it to our local market and what it means to us more so. But before I get into that, I just wanted to start with a really positive news story. So numbers just released in the last 24 hours for our great state of South Australia show that we are the #1 performing state right now over the last 30 days for capital growth, guys. So congratulations. We're ahead of Sydney, Melbourne and Brisbane. The growth has been modest at 1.7%, but to be #1, to see the growth that we're experiencing, shows that things are really good with our marketplace at present. I'm going to share with you some facts that are probably going to support why that's happening in comparison to, I guess, what 60 Minutes conveyed, and it's probably going to contradict that a little bit. But to all my investor clients, my developer clients, my mums and dads who own the family home to multiple properties, myself included, it's fantastic to see that we're #1 across the nation for capital growth right now. All right, jumping into the 60 Minutes episode on Sunday night. So for those of you that didn't see, I'm sure you can jump on their website somewhere and access and re-preview what I'm about to speak about. I'm not going to go in and review every aspect because we haven't got all day, obviously, but I'm just going to take snippets of it and break it down as to what's important to us locally and what that means to us in our marketplace. And I'm really going to give some substance, I guess, to support my argument. I did find the journalism to be very one-sided and quite biased, and like always, the media never paints a positive picture. It's obviously there to look at, placing the fear of God in everybody's eyes and ears, but really I just wanted to relate it to what it meant to us. So #1, this leads me to my biggest topic of frustration, is media speculation and the hype surrounding it. Guys, obviously, the media is never going to paint that pretty picture that we want to hear. But one of my biggest frustrations and a lot of the most common questions I get is that people base their assumptions or predictions or what's happening locally on what the media is telling us. Now, the thing is, often the media will base their speculation and their story on what's happening in the eastern seaboard, so places like Melbourne, Sydney and Brisbane. Those marketplaces are significantly different to our marketplace locally here. So you need to be really conscious not to fall in that trap of just what Sydney's doing is a reflection of what's happening here. Because the opposite's happening right now. I mean, we're #1 for capital growth, as I just said. The opposite's happening for Sydney and Melbourne. Their markets are dipping. They've had the big peaks, and this is what I mean. Sydney and Melbourne will have, significant capital growth, sometimes 10 or 15%, but attached to that is higher risk. Whereas here in South Australia locally, our capital growth is more modest, somewhere between 1.5% to 3%, but our risk that's attached to that is much lower. It is more conservative, and the long-term stability is probably got a better track record here. So first things first, guys, don't base your market assessment on what the media is telling us, because their assessment is generally going to be based quite biased on the eastern seaboard. Okay, so this is why it's really important that you reference the quarterly reports that I'm sending you and speaking to you each and every quarter. I'm passionate about sending those to you guys for a reason, not because you're thinking of selling. It's to keep you informed on what's happening exactly in our local marketplace and our community. It's what I live, breathe and do each and every day in the property and real estate trenches here in our local market. So make sure you're referencing that, please. The second thing that I want to point out is, I guess, the investors that they interviewed. I felt really saddened by what these investors had gone through and experienced, but I guess at the same token, we all enter an investment strategy with risk attached to it. But I guess, like I said before, they based this story on the Eastern Seaboard, a local community up in northern Queensland, some mum and dad investors who built up a substantial portfolio in a very short space of time and did exceptionally well at the beginning. But I guess their strategy was short term, and it probably was one of the biggest things that led to the downfall of their portfolio. And in some cases, we're talking in excess of $5 million in a portfolio. Now, what ended up happening and what stood out to me is these guys put all their eggs into one basket. They didn't diversify their investment approach. So pretty much what they did is they borrowed a significant amount of money on interest-only components, possibly pushing themselves above their means to service the whole portfolio. But they went into a local community that was going exceptionally well. It was a local mining community that had exceptional capital growth over a short period of time. Rental yield was very strong. Vacancy rates were absolutely at an all-time low. And they got in while the going was good. The unfortunate thing for them is because they put all their eggs in one basket, they had a short-term approach without a long-term vision. And what this meant for them is that eventually, the going can only be great for so long. The mining company left this particular community, which absolutely decimated it, because the mining company brought all the people there, brought the jobs, the infrastructure, the people that went there to work for the mining company needed accommodation. This pushed vacancy rates to an all-time low, rental yields up exceptionally well. In some cases, the properties were positively geared, but obviously as soon as the mining sector left, so did everyone else. So all of a sudden they had properties that were vacant, vacancy rates were exceptionally high, they had to drop rent to try and attract people into the property, and they just couldn't get people in these properties because employment was gone, infrastructure, services, basically everything, you get the picture, had pretty much been decimated by the mining company leaving. Ultimately what happened? It slashed the value of the property, and they couldn't service it based on what they had borrowed times 4, 5, 6, 7 times over properties, and ultimately it meant that the value of the property dropped, and we're talking a substantial reduction. In some cases the property value almost went to a third of its original value. So the lesson here, guys, is diversify your strategy with investment. Don't put all your eggs into one basket and just buy into a community just because the timing's going good then. Sure, have a short-term vision, but also look at another investment option that's going to have long-term vision. So an example might be investing in this mining community with a short-term vision to get some quick capital growth while the going's good, but offset that maybe with a property that is positively geared somewhere else, or a property that has negative gearing benefits somewhere else, or even a property that has great tax depreciation benefits in another location, or something that your self-managed super fund may run and support. Whatever it may be, guys, this is about having different pillars of income investment-wise at any point in time, so that if one goes a little bit quiet or a little bit south or a little bit sour, you can still afford to hold that because your other pillars of investment income are still firing across the board to, I guess, counteract and counterbalance what may be happening there. So diversify your investment. This leads me to my second bit of advice. I'm not sure what advice these people did or didn't get prior to their investment strategy. I'm assuming with them putting all their eggs into one basket that it was no advice at all. But most people will speak to their bank manager to get real estate or investment advice. Most people will talk to an accountant, a financial advisor. I guess probably the biggest misconception with the marketplace is people don't engage a local agent to buy if they're looking to invest in a particular area. Most people's understanding of a real estate agent is to get people sold. Sure, that's our bread and butter. We do that every day of the week, but we're absolutely here to help people grow their portfolio. The more people that own property, the better it is for all, us, the economy, the property market, you name it. So what I found from this particular episode on 60 Minutes is I didn't hear the words of us talking to a local agent, because I'm sure if they spoke to a local agent, they would have helped them understand the marketplace, the vacancy rates, the capital growth, the rental yields, the short-term strategy and the risk attached to that mining company being there or not being there and what that meant. They really should have engaged somebody that's in the trenches, in that local market, each and every day to give them insight. So the second thing is engage someone who's local in your marketplace as an agent, guys. We're there to help and support you when you're buying real estate too. The third thing was about, I guess, lending and mortgage rates. So they interviewed a particular expert from the United States. This particular individual goes into countries and assesses the housing market, looks at all the nuts and bolts and the analysis and the statistics. And these guys, they've always been around them. They will always be around. And, you know, he looked at things like the current mortgage rates of Australia. So I think he said something that Australia is the number one country for current mortgage debt in the world at present, and almost half of all mortgages are on an interest-only component, with the remaining on obviously principal and interest. So his biggest concern was, you know, people are being approved for finance, but they're really not in a position to service the loan. I guess what they didn't share was some of the facts of what happens behind the scene when any one of us get finance approved to buy a property. So the first thing that I just wanted to share with you is engage a broker. These guys, I believe, went directly to the bank. Now, the bank obviously looks at things from an applicant point of view. You're just another number. You sit at the bottom of the tray, you get processed through the line until the point that you get to the credit assessor, and if all things go well, you get the stamp of approval. They don't assess your individual circumstances, what you're looking to achieve, what your short-term view is, what your long-term approach may be. You're just another number, guys, basically in the system. So that's probably where these guys went wrong. They went to their local bank rather than engaging someone like a financial broker. If you're not working with a broker, I'm happy to put you on to somebody. But I guess the advantage of a broker is they would have assessed the serviceability. Now, getting on to what he was talking about, the interest-only aspect of mortgages, just so people understand, the banks don't just look at things from a point of view of what the interest rates are now and today, and if you can pay or hold that cost, because those things could change, and they are variables that could change at any point. So most banks, just so you understand, won't approve you on a 4 or 4.5% interest rate, and if you're not on that rate or less, you need to talk to me to get onto a better rate. They'll generally forecast for an increase in rates, and generally they'll approve loan applicants based on a 7 to 7.5, sometimes even an 8% interest rate, so that if the economy ever got to that point, could you afford to service the loan at that point in time? So just understand that they'll forecast a higher interest rate than what's being offered right here, right now. I guess the other advantage with a broker is not just the rate. This is another misconception in the market, is people base their decision on a financial product based on what the best interest rate is. This is not always correct, guys. Each product is different for each individual need and purpose. So just because a particular product has the best interest rate doesn't mean that it's the best product for your investment strategy. So again, working with a broker will give you this common knowledge of what the best product is, what the best rate is for that product for your investment needs, and obviously they'll ensure that long-term longevity in your investment strategy is absolutely achieved. So guys, 3 things. Don't base your opinions and assessments on the Eastern Seaboard and what the media is speculating, because that is vastly different to what's happening in South Australia right now. The third thing is diversify your investment strategy. Do not put all your eggs into one basket at any point in time. If you need some advice or guidance on this, pick up the phone or flick me an email. I'm happy to have the conversation with you about your options. The third thing is work with a broker. Again, I can put you onto somebody that will look at all the financials, the nuts and bolts, with a long-term view, not just a short-term view of getting you approved here and today. So it's good business for the bank and not in the best interest for you. Guys, just to finish up, some facts. The reason why we are the number 1 state for capital growth right now is for one reason: supply is at an all-time low. In fact, we are back to supply levels of pre-GFC times, so 2009, 2010. We've seen 11% reductions in properties available for sale under the Salisbury Council in comparison to this time last year, so February 2015. Furthermore, we saw a 9% reduction in homes available for spring 2015 in comparison to spring 2014. What that's meant for me locally is 87% of all homes that I've sold in the last 90 days are not selling with just one offer after a period of time. They're absolutely selling with 2 or more offers. So all that I can say, supporting that we're number one with the capital growth over any other capital city right now, is that demand is back in our marketplace, which is great news for us. I mean, at the end of the day, where can you still buy for a medium of 320 to 340, 25 minutes from the city, good value buying, whether you're an investor, a developer, a first home buyer, a mum and dad, whatever it may be. The buying is far better here and better value for money and better bang for buck right now. Guys, thanks for tuning in. Any questions, please drop me a line anytime. I'd love to hear from you. 0423 283 265. Cheers.